moving on to what we can do to prepare as individuals, right? I think when I'm hearing this and saying, okay, if this is going to happen in the next 2 years, how do I change my strategy and my approach? And I sit here and look at the foundations that we teach, and I don't think a lot of this changes. Like, the first one I would say is understand your cash flow management, what's going in, what's going out in your personal life, and having emergency buffers. You're always having them for the next 100 years, aren't you? Yeah. The second one is long-term planning. What do we want and what do we do over the next 5 to 10 years? What do we want in our life? And when we're building a portfolio of wealth, it's a long-term approach to investing, whichever way we look at it. There might be a small component that is short-term, sort of, let's have a speculative play on this sort of thing. The third thing is probably no taking on of any bad debts or any impulse buying as such, right? I'm not just going to go and buy a stock for the sake of it, or go and buy something I don't know anything about, or go and take on more debt in my life that's not going to give me an income or a wealth building exercise, right? So if I'm doing all that, it sounds as though the retractions of, like anywhere from 8 to 12%, if I've got my cash flow buffers, if that actually plays out in all of my portfolio, I can see myself through that, which I think is the number one aim, is to be able to say, well, if retractions occur and the ups and downs in real estate are evident, and that happens everywhere, and you've got to prepare yourself for any downturn, I know that I'm covered because I'm cash heavy. I'm thinking long term. I'm not emotionally wrapped up in tomorrow. I know it's a long term play, and I'm just going to wait for it to recover. Is that a naive way to look at it, Darren?
John, there's so much I could say about this. I could talk about this for hours because it's such an involved sort of subject. So firstly, okay, whilst I can't give tailored and personalised financial advice, so there's that. Yeah, that's right. Your line of thinking, from my point of view, is correct. Now, we call it a cycle, yeah? Well, a cycle has a beginning and a cycle has an end. But then it begins again. That's why it's a cycle. So what you've got to do is you've got to think about not only the here and now. We know we're coming close to the top and there's going to be a reaction to the downside. But you need to start also laying the groundwork for when the next cycle comes. Because inevitably, things will bottom out and they'll start to go up again. So, generally speaking, think about today, while the banks are still your friends, they're not putting pressure on you, and I'm sure for overdue credit cards or the mortgage payments, which hopefully people are getting a little bit of relief if they contact their bank and ask them to pass on the full rate for them there. We've got a window of calm before the storm hits. So start planning now how your portfolio is going to look, how you're going to protect yourself. So simply look at it from the bank's point of view. What makes the bank happy? Well, can you guarantee that you can still pay your mortgage bill on time? That's the first one. Do you have a lot of car loans, credit cards, that sort of stuff? Banks would like it better if you sort of got rid of those before things get really tight for them. So that's personal debt load. That's something we can all look at and start to manage. In terms of investing, I use a term called profit and protect, which I think sums up very well where we are at the moment. Because there's still upside in markets now, John, both in real estate and stock markets. But you certainly don't want to go heavily into leverage at this time. Because when it snaps back, you're going to be the first casualties that banks are going to start calling in those loans for, So you need to be very careful there. But I'll end on this one as well. If you're heavily into property and you've bought in good locations, well, here's a fun fact. A good location is just that in the good times of the economy and also the bad times of the economy. And so unless you have an extremely compelling reason, I don't know, say you're going to retire and you're going to cash up, that's fine. But if you don't have a compelling reason, PSE is not advocating that you go full on sell everything and, exist in a tent or something and then come back into the buy. Don't do that at all. A good location, good yielding investment property actually represents an excellent stepping stone for you personally to take advantage of your timing and start moving back into the markets when this current cycle bottoms and it turns around. Now, most people, I guess, aren't thinking maybe that far ahead, and I understand why. But these are the considerations I feel that our members at PSE were going to be highlighting to them. And right now, when it's the calm before the storm, is the time to think dispassionately and with no emotion how you're going to play those out. If you have, an apartment or something that's not really going to yield very good returns in a down session stuff, then yeah, if you wanted to sell it now, go for that, consolidate your portfolio, get rid of the worst performing assets that you've got. But certainly don't sell your own principal place of residence. Don't sell, unless you have to, places that are in top locations, because those locations will still be desirable even during a downturn. And they provide an outstanding platform for people, if they understand their timing, to take full advantage of the next cycle when it starts as well.
And if we look at the GFC as an example where there was that correction and credit was a little bit hard to get, and we did see investors, have a period of struggle, there definitely were those people that were ready to buy when that cycle changed, and they were getting great deals. So I think it's great for people who haven't seen these cycles before to get a better understanding of them and know where we are in the cycle. I know that Australia and America might be very different in their volatility, but there's still that cycle, and knowing it can give you so much power, especially if you are planning on buying when it starts to turn around.
Yeah, I agree. Just having the timing just brings a large sense of calm to you. And it informs better investment and business decisions as well, because you understand the landscape of the economy. You can actually see how the economy times itself. That's something that we're very big on teaching. That's what I try to teach in the newsletter and the Boom Bust Bulletin as well. It's being able to see through the news to what's actually driving things. And it's almost always the land market. And if it's a land market, then it can be timed.
Interesting stuff.
If you were giving a top tip to a property investor that hadn't seen a cycle before, and they were maybe wanting to ask, what would my thing to do be to prepare for this cycle? What would your top tip be for an investor that hadn't seen these cycles before?
Well, if you're a residential commercial investor, it would be slightly different because historically commercial property tends to sort of outperform residential when we get near the peak. I'll give an example here in Australia. Go and look at what data centres in Sydney and Melbourne on the outskirts are bidding for the proper industrial land that suits data centres. I mean, you're going, I don't know, the average in Melbourne's probably about $300 per square metre. Microsoft and Amazon come in and double that. They'll just completely blow the competition out of the water. And you've got real estate companies like Collier coming out and admitting, yeah, actually, this will increase land values. Hello. But yeah, back to your question, Rachel, and it's a good one. So a top tip to sort of prepare. You've got to stress test your portfolio. If you're brand new to investing, I would say arguably buying an investment property now shouldn't be your utter priority, even though we advocate that you should own some land. But if you're trying to buy your own principal place of residence, really there's only 2 times every 20 years where that's probably not advisable. And we are approaching that. But right now, if you wanted to buy your own principal place of residence, it's still fine to do. But just understand that you're going to need to have a robust plan in place to either put more than the normal deposit down or have the ability to very quickly build up equity in that property when things turn down so that you can keep the bank on your side. So my answer to your question is it all comes down to debt. There's no new way to go broke. It's always too much debt. So be very cognizant of how much you're taking on and take the time now just to review your own personal investment debt load and see if you can work out some simple but effective ways that you can minimise those debts now.
So you mentioned about the debt levels, and totally get that. The higher we're leveraged, the riskier it is. What's the risk of having an investment property rather than an owner-occupier through this time if A, I've got the yields, and B, I can repay the mortgage each month? Like the bank don't come and knock on my door just because I've lost 5% in valuation.
No, the bank won't knock on your door until you're in arrears substantially on your.
So if I'm always paying my mortgage on time, I'm never in arrears, what's the risk of whether it's an investment property, an owner-occupier or commercial?
Well, if you're geared 110%, and you have a 5% drawdown, you're getting a phone call from the bank, whether you like it or not, you know.
I've actually never seen that happen.
No, I haven't either.
In my 20 years of lending.
it's
Unless it was
more,
a commercial property.
If it was a margin loan, different story.
Yeah, it's something that can happen at this stage, the very late stage. I've seen it happen in the UK and the US where they're offering those mortgages and additional. So it ends up being like a 110, 105, 120% sometimes loan that you can get for properties and stuff. That's part of that mix of that real speculative sort of fever that, you know, that takes over. But no, I think, a 5% downturn won't see your bank put repossession notices in your mailbox at all. But you start to think maybe if you want to hedge yourself and you're an investor, have a look at the rent that you're charging, the quality of tenants that you have. And maybe what you might want to think is maybe for the next few years, possibly extend a longer term lease to a good tenant just to keep them in place and just have a nice income floor to your asset property as well. Because a lot of people are going to be doing things very, very tough. It's no guarantee that people can afford the rents that you may be offering during a recession. And certainly an investment house that hasn't got anyone in it isn't yielding any income. And that puts pressure on your own cash flow then to be able to step up and manage that mortgage. And as I said before, I think now in the calm right now is the time to sort of game plan this sort of thing and think about, what happens if a tenant has to go? How would we replace that income or replace the tenant with someone who's equally as diligent with their payments, looks after the property like it's their own, that type of thing. So it could just be, if you've got good tenants, maybe, in the next year or two, sound them out about, would you like to have just a, 2 or 3 year lease with optional, rental reviews at the end of that 12 months. And, if you're doing it tough, we'll just keep things there. That's just for me, just a simple option that I would look to do myself across my portfolio if I felt that, I was in an area that was going to suffer particularly badly.
Yeah, that's an interesting theory.
I think the other thing is the interest only versus P&I.
That's another one
if
too.
If we've got 4 properties and they're all P&I and all of a sudden I've got a bit of a credit crunch in my life, then we're going to be exposed or a little bit higher risk. So can we just look at mitigating that by having some interest only options?
Yeah, and then you come to the contractual repayments. So, you talked before about the bank. The bank will only ever get involved if you're in arrears of your home loan. So if things do get a little bit tougher and if we are heading into something, my advice for someone who'd be planning for that would be to look at your minimum contracted repayments and maybe stretch those out now while things are easy, but then you can always pay more.
That's
but
right.
That contracted part is the only thing that's going to come into play if things do get tough, if you're behind on your contracted repayments. So, interest only might be a great idea.
Yeah, and just having those offsets or redraws, having surplus funds in them so we can draw upon them when S hits the fan.
I was thinking about that too, actually, John. I can't remember, but I was sure I could recall back in 2008, 2009, etc., that certain banks, I don't think it was the big ones, I think it was the shadow banks, the non-traditional ones. If you had an offset account with them, they actually froze it for a time to make sure that they constituted the equity they needed to backstop the loans taken against the property.
It was a redraw, not an offset.
But yes, there
was a case of that, 100%. But it was redraw, not offset.
Yeah, I'll have to relook at that as well, because that's quite possible that may happen again. I think that would be useful information to tell, for instance, our members and your guys as well to have a think about that as well as a possible obstacle over the next few years.
And I suppose it's timely to mention that I don't look at a bank contract when I sign it and say, yeah, give me a loan, I'll read through the terms and conditions. But what's in there is an all monies clause, isn't there? Where they basically say, well, we've got access to your money, and if push comes to shove, we can take that money to pay down some debts if we need to. Now, does that get used? 99.5% of the time, no, that doesn't need to. If we continue to pay our bills on time, they leave us alone.
Yeah, I don't think there is the all money clause in most lending now. It's just they can only take what's secured against that property. They can't come and take other things.
I must have the wrong contract.
Yeah.
So no.
But there has to be a default position, and then they can come for you afterwards. But they can't just turn off your accounts or freeze your offset.
So a lot of the all money clause has been taken out?
Yeah, so if a bank holds two properties of yours, they can't just go and sell the other one because you're defaulting on one. They could come to you personally afterwards, but they don't just get to choose.
Yeah.
Yeah, I mean, our big banks, I think, they're very well capitalised at the moment. They have, for the most part, good oversight from APRA on what they do. They've got adequate capital buffers, as far as I can tell at the moment as well. They are actually well positioned to ride out a decent fall in land prices generally. The worry for me is what we call the shadow banks, the non-traditional lending. And this time, we've seen data, which I showed to my members a few weeks ago, in fact, from the RBA, very, very deep in their research, that showed that lending from the private credit is now almost equal to more traditional bank lending when it comes to residential home loans. And that's a concern because they're not very transparent at all, because they have no reason to be transparent. They exist where they do because there is less regulation. So out on the margins, when something really breaks, that reverberates through the system and really starts creating a tsunami of defaults throughout the financial system, I would not be surprised at all that it's one of these mobs out there that has a large group of bad debts it's all based on trust, isn't it? If you don't trust that person you lent to can pay for you, you call in the loan. And if they can't pay it, it reverberates. So that's my concern. But I think the big banks here in Australia, just from my opinion, I think are well positioned at the moment. Now, that could change in the next 12 months. They could go on an absolute lending frenzy, reduce those buffers right down, and then you're starting to question, just how well stocked they are for what's coming. But at the moment, I think that Australian banks are well positioned. They've learnt the right lessons from the so-called GFC.
In the back of my mind is always the Warren Buffett quote, when others show courage, I show fear. When others show fear, I show courage. So I think we've always just got to I don't think there's alarm stations right now. I just think we've always, as investors, we've got to be always eyes wide open, don't we? And we've always got to be looking in our own backyard first with our foundations of our life that we mentioned before, and just expecting something to come upon us that is like a little bit of a brick in the road, where we say, okay, we can navigate through that because we've forecasted it or we planned for it.
And I think investors will hear a lot of different theories and a lot of different opinions. And, you take from that what you wish to. But I think one thing is true, that you need to be prepared for things to change. And buffers and savings and, shoring up your lending is important. And maybe like Darren said, if there is something that's not performing in your portfolio, maybe consider it.
Flick it, yeah. If you wanted to increase your knowledge in this space, there's, and Cathy got me onto this quite some time ago, there's a book called 100 Years of Land Value in Chicago by Homer Hoyt. Now, I don't know about you, Darren, but I found this really hard to read. Lots of lots of pages, small writing, unbelievable amount of content in there. So I did skim through that. Secret Life of Real Estate and Banking, Philip Anderson, great book. Boom Bust 2010, Fred Harrison actually predicted the GFC. And then probably the latest one, which I've found the most benefit from, just because it's probably brought all that together, is Akhil Patel, The Secret Wealth Advantage as well. So, yeah, there's a lot out there. There's a lot of information that you can consume if you're really into this. But hopefully today we've given listeners just an insight into I suppose another perspective, because a lot of media outlets, a lot of marketers are out there at the moment saying, wow, how good's this? Interest rates have just dropped once again, and we can obtain all this lending from banks, and let's go and buy. But you've got to be very careful as to what you buy.
Yeah, market tops generally won't happen until we're all in. And to get everyone all in, we all need to feel very good, happy, and secure about the future, and that's the great trap, and that's what's starting to build now. Particularly if you're involved in crypto as well, there's just no dissenting voices are seemingly allowed, which is a massive alarm bell for me personally.
And that's what they call the winner's curse.
The winner's curse.
That's it. The mania phase. The mania phase. That's we have a property clock on our website. So if you go to propertysharemarketeconomics.com. It's dominated by a clock, and that clock has an inside 12 hours and an outside, so it makes up 24 hours. So at the moment, our clock is at 2 p.m, and if you hover your mouse on the clock, actually it gives you a brief description of what each hour means. But yeah, we are in what we call the winner's curse. We sort of call it that because if you win at that auction and you've bid $500,000 over the expected asking price you wanted to pay, well, now you're cursed, because in a few years' time, when things turn over, you're going to be in all sorts of strife. So we tend to call it winner's curse, and it's a exercise in opposites, where there's things that you should be doing now, which are actually contrary to things you're reading or hearing, or in fact the general mood at your average barbecue or down at the local pub and the things that people are talking to. They're all signs that things are starting to get a bit toppy, a bit frothy here. I need to take a step back and actually start to do the opposite to what everyone's doing. So, mania phase or winners, because I think it's an apt name for it.
Very good. Well, appreciate you coming on today, Darren. Any final insights for our listeners today?
Oh, look, if you're interested in land economics or the real estate cycle, come and peruse our website. There's no obligation. Have a look. We do offer a free weekly newsletter. You can sign up for that on the website. There's no ongoing obligations, just your email. And for your viewers in general, look, you've got time. The best sense right now is common sense. And if you do the preparation now, then you'll do fine during the downturn. You'll wear it out. You'll be emotionally attuned to block out all that bad news. And with luck, if you know some time, and you'll actually be able to prepare and come out of the wreckage in a much, much better place than what you went in.
And that's the thing, it's knowledge and mindset, isn't it? But and I think the positive of this is if you stay cash heavy, you're appealing to the banks, then on the other side of it, you've actually got more leveraging power to be able to go and take real advantage of this as well. So appreciate you coming on. All the best. Thank you.
Thank you,
Rachel,
Darren.
John, thank you very much. It was a pleasure. Great questions and great company. Thank you so much.
All right. Bye.